Now, when you look at the gold spread versus XAU, you'll see that if you break the XAU out on a relative basis out of that basing pattern, bottom of the page, breakout, you could triple that spread relationship just to bump the bottom end of that multi-decade range that prevailed from the 1980s, 90s into 2000. It's up around 17%. From the current spread level, that's a triple. What does that mean? It means in the next up leg in gold, probably a more accelerated leg than we've seen so far, the miners will take off relative to gold. The public will finally realize, gosh, gold miners.
Gold miners have recently started catching up. The VanEck Gold Miners ETF rallied 2.2% on Wednesday, marking its highest level since late October and extending its winning streak to 6 weeks, the longest since July 2020. Year to date, gold mining stocks have outperformed all other industries, surging 18.9%. Global expert and proprietor of Momentum Structural Analysis, MichaelOliver, argues that as gold enters its next major upward leg, mining stocks will likely experience a dramatic surge. He expects that once the public fully recognizes the potential of gold miners, they could see massive gains relative to both gold and the stock market. Oliver highlights gold's significant rise from $1,050 in 2015 to over $2,800, outperforming the S&P 500 in the past year. Despite this, mainstream media such as CNBC and Fox Business continue focusing on the stock market bubble rather than gold's strong performance. Concurrently, Oliver expects that as the gold bull market continues, it will follow historical patterns such as the 2010-11 bull market, where price gains accelerate in later stages, attracting more public interest. The price of gold in US dollars jumped 25.5% in 2024, barely outperforming the total return, including dividends, of the S&P 500, which amounted to 25%. In January, gold popped another 6.4% to a record high, compared to a 2.8% total return for the S&P 500. Lower interest rates are generally a catalyst for higher gold prices because they reduce borrowing costs. However, geopolitical uncertainty can have an even bigger influence on gold prices. Turning to silver, Oliver notes that while many investors remain skeptical about these assets, silver has greater percentage gains than gold. After gold's 27% leap in 2024, many are asking if the award for best performance in 2025 could belong to silver instead. Multiple analysts think so, including a prominent strategist from Saxo Bank, who remains bullish on silver's prospects as we enter the new year. Now we present the clips of MichaelOliver's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
We see the ongoing trend in gold. Okay, now there have been, since 2015 low, it was $1,050, and now we're 2,800 plus. And so it's a nice move. And in fact, it's hard for people to believe because they're all focused on the stock market bubble in the U.S. But if you go back to 2015 low, gold is only slightly underperformed the S&P. In fact, over the last year, it's beat the S&P. Yet there's nobody pounding the table or screaming that on CNBC or Fox Business News. It's all the stock market. And yet gold has done quite well. And yet people are skeptical. That's fine. I like that. Keep it that way till later in the trend. Then it gets excited. And that's when you make a lot of money, when the latecomers join. But then the area that we're most interested in, that I'm arguing is likely to happen, is that in this phase of the gold bull trend, and we're now 9 full years into it, okay, and there's been some other bull trends that have lasted this long, 2000 to 2011, 11-year bull trend went from $260 to 1920. A lot of it occurred in the last year, which is quite typical with the gold bull moves. And silver as well, where you arm wrestle your way up and then you accelerate, and that's when the public suddenly says, "Gee, I want in." And they're motivated because of other factors. Maybe the breakage in the stock market, for example, causes money to flow. But when I look at the gold situation right now, most people involved in that market very skeptical and nervous about silver and the miners, the gold and silver miners. Mm-hmm. And they think, these are dogs, And we even use the phrase, silver's a little wild dog on a leash of gold. If gold's going up, silver's going to go up too, believe me. Silver might have sharper corrections, but then if you examine it closely, it has sharper upturns percent-wise. And it's held its own versus gold quite well on a percentage basis. Last month, for example, silver beat gold. Last 12 months, close of January 2024 to the close of January 2025, if you listed all the asset categories like gold miners, silver, gold, S&P, NASDAQ, T-bonds, etc., the greatest performer was GDX. It's mathematically true. Even though GDX is not out above its 2020 price highs, which was $45, we're pushing at 40 right now. Gold is, and yet on a percent basis, GDX has actually beat gold over the last year, price to price percent gain. Silver, gold, and then the stock market's way down there. And yet nobody notices that the monetary metals for a year now, and last month especially, are beating the pants off the stock market. And yet there's no cheering. I love that. Again, the public doesn't notice, especially over here. But the miners, historically, even though they've recently outperformed, especially over the last year, for example, are very, very cheap in relation to their historical relationship to an ounce of gold. They're very cheap in their relationship to the broad stock market. In fact, if you look at a spread chart, and the first one you can look at is the spread chart of the XAU index, which has been around since the 1980s. GDX, for example, the ETF, has only been around since 2006, I think. So we reference XAU, and it's pretty evenly weighted index, by the way. It's silver and gold miners, not just gold miners. And if you bought XAU at its bear market low in 2015, its low monthly close, I think, was 45. Right now it's 155, okay? You do the percent gain from that bear low to the current price, beats gold handily from its bear low to its current price, even though gold is out above its 2020 highs yet in that period of time. But still, when you look at the spread relationship between the miners and those assets, gold and versus the stock, they're dirt cheap. You look at the spread chart and they're just laying on the floor. Oh, they're holding their own. They're actually gaining a bit over the last 9 years versus stock market and gold. But they're still dirt cheap historically.
Reflecting on gold trends, MichaelOliver explains that current momentum structures are still positive for gold, and there is no indication of a downturn. While factors like gold and silver shortages will impact prices, the broader driver for gold's rise is the ongoing decline of paper money, particularly government debt. This will eventually lead to central banks taking action to defend institutions, accelerating inflation and boosting gold prices. In a report shared Wednesday, the World Gold Council highlighted that total gold demand, including over-the-counter investment, rose 1% year-over-year in the fourth quarter, setting a new record of 4,974 tons for 2024. The 2024 Central Bank Gold Reserve Survey, conducted by the World Gold Council, shows that 69% of the surveyed central banks anticipate making further net purchases of gold reserves, though at a moderate pace. The survey highlights gold's importance as a strategic asset for risk reduction and the diversification of foreign exchange reserves. Additionally, 83% of central banks in industrialized countries view gold as a hedge against inflation and a safe haven during times of crisis, while this percentage rises to 90% among central banks in emerging markets. Let's get back to the interview.
I measure the price momentum action of the underlying market. So yeah, we look at gold price, XAU price, stuff like that, silver, but we're really looking at the momentum structures, meaning annual momentum of gold. How does it look versus its 3-year average when you oscillate it? Quarterly momentum, monthly momentum, etc. All those factors are positive, and they're not near, especially annual momentum is not even near something that it might break and indicate bear trend. All the other major upturns and downturns in gold for the last 5 decades have been definable via annual momentum. Whereas if you plotted the annual momentum chart, you would say, oh God, there's a trend line from hell. You don't want to break it. So you broke it in late 2011. Price didn't break anything, but gold said, that's it, I'm over. Same thing happened in 2015. As soon as you made your low, 2 months off that low, you broke out over an annual momentum base. Since then, nothing has developed on momentum that says top. Therefore, you're still in the trend. So that's what we look at. And yes, there's factors like this that you're talking about, the shortage of available gold or silver, that will impact those markets, and they'll become emergencies. But ultimately, there's a bigger driver, and it's not just those specifics. It's the ongoing degradation of paper money. And whenever you get a situation where certain assets are in jeopardy, particularly government debt assets, which is now the issue, especially in the U.S., we know there's a monster out there, and it's going to happen, and probably soon, in terms of what the hell are we going to do for that debt relationship. No longer mortgage issues. Now it's the government debt. And we have a stock market bubble. Those are the kind of factors that provoke the central banks into doing what they were invented for. Defend the institutions we want you to defend. Government, banks related to government, etc. And that's what they will do. They'll put the pedal to the floor, despite their recent academic meanderings about how, well, we're in this balance point. We're going to be with two mandates here. Once we shift into the dark economy, I don't care. I guarantee you that the unemployment issue is not going to look good anymore. It doesn't even look good now, but they won't have the excuse anymore. So even though commodity prices will be going up, that's going to be a predicament for them. When they have the data points go dark, employment, for example, that's when they'll push the pedal to the floor, and so will their associate banks, Bank of Japan, ECB, et cetera. So it'll be global reinflation again in terms of acceleration of the decay in the value of the money units. That's what drives gold.
The price of gold can swing dramatically based on sentiment and global changes in supply and demand. Right now, it's important to understand that traders are having big impacts on gold, and that its price could be moving up for short-term reasons rather than the long-term value of the commodity. Given the ongoing rise in gold and the growing momentum of gold miners, will the stock market bubble eventually shift investor focus toward precious metals? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.